Hello everyone, thank you all for watching. In today's video, I'm going to be speaking about a very important concept when it comes to dividend investing, and that is yield on cost. And I know that a lot of new dividend investors are probably unfamiliar with the concept of yield on cost versus dividend yield. I know that I was one of them. I was unfamiliar with the concept when I started first investing as well. So I'm going to be speaking to you about that today, as it's a very important concept. And if you do enjoy this content or content like this, please like and subscribe. It would be greatly appreciated. So this Reddit user made a post on the community R Dividends a couple days ago speaking about yield on cost and what it is, and what does it mean, for example, that he yields $500,000 to $600,000 on his $1 million investment. And I believe this user is speaking about Coca-Cola, because I know his yield on cost, Warren Buffett yield on cost, is insane on Coca-Cola stock. I believe it's around 40 to 60%. So his yield on cost is probably one of the best there is, and that is probably what this user is speaking about. And when it comes to dividend yield, I think that a lot of investors are already aware of this concept. It's simply the yield that they're currently getting on the investment itself. So in this case, SCHD has a current yield of 3.55%. And it's a very easy number to calculate. You just take the current dividend rate. This is going to be trailing 12 months, which was $2.60. And then you're just going to divide that by the current stock price, which is $73.40. So you get a current yield of 3.5% roughly. So when it comes to dividend yield, what that number is looking at is just the 12-month trailing dividends divided by the current stock price. It's just a snapshot of what that dividend is paying currently as compared to the fund's or stock's current price. Now, what that doesn't account for is dividend growth. So over time, your dividends in the class, the asset, so in this case SCHD, will grow over time. And now the amount it grows varies, but it's important just to know that dividends should generally, if it performs well, increase their dividends or increase over time. So to kind of illustrate this concept, let's say that you invested $10,000 into SCHD today. That will buy you roughly 136 shares, and your dividend for the year would be about $354. And that would be the $10,000 you invested gives you $354 in dividends, which works out to about 3.55%. So now to illustrate yield on cost and the power of it, let's say you bought $10,000 worth of SCHD, let's say about 10 years ago. And we'll say that the price 10 years ago was $29.08. So if we divide 10,000 by 29.08, we get 343 shares you would have received. So now on that $10,000, I want to see what the yield on cost, or rather not the yield on cost, but the yield was at that time, and then we'll get into yield on cost later. So I'm going to calculate all of these dividend payments and add them up to find the yearly payment. So after adding all the dividend payments received in 2012, we get that you would have been paid out 81 cents in 2012 had you have bought SCHD then. So if we multiply the dividend received in the year times the amount of shares on 10,000, we get that you would have received a dividend of about $278 for the year. And that is going to be a yield at that time of about 2.79%. Another way of saying it would be that you are getting 2.79% cash on cash for your return. So on the $10,000 you invested, you receive a cash on cash return of 2.79%. Now, what this doesn't account for is the dividend growth over time. So as I said before, you should be investing in things that, of course, grow their dividend over time, and that will greatly impact your yield on cost. So let's say that you held on to your shares over 10 years and you didn't invest in anything else. You didn't dollar cost average. You just left your investment in there to generate you more income and to grow its dividends. So as I said before, you bought $10,000 worth of SCHD for an average price of $29.08 per share, and you had 343 shares, and that would have yielded you that amount of money in 2013 and in 2012 roughly. But as I said, dividends grow over time, so I'm going to calculate what the dividend you would have received had you have held and you didn't sell anything. What would you have gotten over the past 12 months? So I'm going to add those numbers up together right now. So over the past 12 months, you would have received a dividend of about $2.60. Now I'm going to multiply the trailing 12-month yield currently by the number of shares that you bought in 2013. And we're going to kind of just keep it simple and just round it a little bit. So you would have received $894 in dividends roughly on your shares that you bought in 2013 on that $10,000 you initially invested. So if you are to divide that number by the initial investment, you would have a yield on cost of about 8.95%, which is a pretty good number overall. So in other words, that $10,000 that you invested in 2013 and 2012 is now giving you a cash-on-cash return of about 8.95%, which is great. And it kind of shows you the power of increasing dividends over time. It can really impact your yield on cost and overall determine whether your investment is good or not. And to kind of even show even better on an Excel spreadsheet, had you have bought a stock at $25 a share that paid a dollar dividend, it would have had a current yield of 4%. But let's say it had a dividend growth rate of 10%. So every year the stock pays 10% more in dividends. So year zero, you would have gotten paid a dollar, and that would be a 4% yield on cost. And in year two, your dividend would have increased by 10%. So you would have a dividend of $1.10, which would give you a yield on cost of 4.4%. But let's say we expand this out further and further, and you can see the impact over time of an increasing dividend, what that does for a yield on cost. So over time, the dividend just grows almost seemingly exponentially. So by the 10th year on your original investment, you're getting paid a dividend of $2.59, and your average price would have been $25 a share. So your yield on cost would be over 10%. So the cash that you initially invested is now returning to you at that point about 10.4%. And that is an incredible increase, and that I would consider a great investment, because if you think about it, just on your dividend, you're getting on your cash a return greater than the anticipated average return of the S&P 500 per year. And now this doesn't include, of course, if you were dollar cost averaging, because you'd be buying in at the current yield. So it wouldn't include that. So just keep in mind that if you do dollar cost average, it won't really be the same. You'll still have a higher yield on cost over time, but you're still buying at the current date, so your yield on cost won't increase as much. But still, overall, you're going to see a increasing yield on cost over time. So the initial Reddit post was speaking about Warren Buffett and his investment in Coca-Cola and what it meant to have that high of a yield on cost. Now keep in mind that this article that I am showing here was written in 2013, so the numbers did change a bit. At that time, Buffett's average price per share was about $3.25. Probably stayed the same. I don't know if he bought since 2013. I couldn't tell you. But at that time, the author of this article calculated the current dividend yield in 2013, and that was $1.30 per share divided by his average share price, and that was 40%. So it's incredible that Warren Buffett, on his Coca-Cola investment, which is probably one of the greatest stocks, Coca-Cola is bought everywhere, it's nearly in every country, it's returning him just on his cash in dividends 40%. That's not even including capital appreciation. So if you think about it, like imagine buying a house for $100,000 and then getting $40,000 every single year in rent alone. So you're not only collecting $40,000 a year in rent, which would be incredible on your initial investment of $100,000, but the property itself could appreciate in value too, and you can get gains there. So it's very powerful what yield on cost can do for you over time if you let dividend growth work for you. So kind of final illustration here, I am going to match this high dividend growth stock against a high dividend stock. So initially the current yield of ABC stock was 4% and its dividend growth was 10%. So XYZ stock has a current yield of 8%, but its dividend growth is only 1%. So you're getting more money currently, but the dividend growth is less. So let's see how this plays out over time. So in year 0, you're currently getting $2 a dividend per share, and that's 8%. Year 1, the next year, you would be getting $2.02, and that would be a little bit more than 8%. So if we bring this out over time, we see that if you were just investing in a stock for current yield, you're actually going to perform less over time than a stock with dividend growth. So your yield on cost will grow far less, and you'll see that over time you're going to be getting a worse cash on cash return for your investment. Now, of course, if you need current income now, then going with the current high yielding stock wouldn't be too bad of an idea. But again, if you're a younger investor, you definitely want yield on cost to grow for you. That way you can, of course, get as much money for the initial amount of cash that you invested. So thank you for all tuning in today. It was a relatively short video and straightforward. I know it is a kind of almost a beginner concept, but I know, judging by the posts on Reddit about this, which you can see here that there are multiple posts regarding yield on cost, that it was an important topic to cover, just to give people an idea of what it meant to you as an investor, especially as an dividend investor. So thank you all for watching today, and I will see you in the next video.